Crypto spring, macro, the final flush into the bottom of the economic cycle, but assets are already looking through it. And AI, the biggest technological breakthrough since the splitting of the atom. I'll start with the everything code because that's where we are today, and a bit into the future. The exponential age is where we're all going. So where do I start with this? Okay, the way to calculate GDP is population growth plus productivity growth plus debt growth. Those are the three large factors that define how GDP moves, the wealth of nations. We have for a long time, and it's been the observable macro trend of my lifetime or my working career, is that we have been in a slowdown in population growth globally, so an aging demographic. So that has meant we have seen lowering GDP over time. Trend rate of GDP has been falling. For the earlier part of that trend, so we're talking about the 80s, 90s, and early 2000s, early 2000s, the answer to that was increasing debt growth and hoping that a productivity miracle was going to come along. Even though we had the advent of the computer, the internet, mobile phone, everything in that period of time, we actually didn't increase productivity per capita. And that's more of a function of aging demographics. So demographics is the big secular issue that society faces. Now, over that period of time, going back a little bit further, there's quite a lot of moving parts here, but going back further, that baby boom generation all came into the labor force at the same time. It caused the inflation of the 70s as you put the largest bulge in population in all recorded history into the workforce and into the consumption force at the same time. They went out and bid for their first housing, first cars, first everything else. We had some supply shocks, and before you know it, we had a structural inflation. But another thing happened is that they came into the labor force. When you put 76 million people all of the same age in the labor force, they compete with each other for jobs. And real wages never went up again, ever. And then these people, the baby boomers, had you lot, the millennials, and they're both in the labor force at the same time. And the millennial population was larger, not as a percentage of the overall population, but in actual cohort numbers. So what you did is you killed the American dream. You killed the dream of increasing productivity leads to increasing real wages. And the answer to that was debt. And so debt growth grew from the 80s onwards, from the Reagan changes and the Thatcher changes in the UK. I think we've even talked about this in the past. And so that build-up in debt offset the inability to buy assets. So they basically, the balance sheet ends up working out roughly that households borrow money to buy assets. What are assets? Assets are future deferred consumption. So that's what an asset is. So they did that to try and get wealthier. But what happened is that whole system became a debt-based system. And in 2008, we just hit the ceiling. Just the whole thing blew up. And it was the defining moment of our lifetimes. What had happened is governments around the world had got to roughly 100% of GDP in debt. Now, if you think about that magic formula, that GDP, the GDP growth, is really what drives savings and investments and also pays the interest on the debt. Now, because GDP growth had been falling over the last 30 years, what you found is trend rate of GDP since about the early 2000s had fallen to about 2%. And interest rates were about 2%. Well, they were a bit higher beforehand. 2007, they were 6%. So what happened is there's not enough money to pay the interest. Because if you think about it, GDP is growing at 2%. You need to pay 100%. You need to pay 6% interest rates on the government debt, which is 100%. But the private sector's 100 and something % in debt as well. So what happened is the whole system broke. The answer to that was firstly cut rates to zero everywhere. And then it was quantitative easing. And it took me a very long time to understand what the hell this was all about. We kind of knew that they were injecting money into the system. What did it mean? How did it work? Nobody knew. We were arguing about it for a very long time. And it was only until really at about 2020 when we saw the next big wave of... So we had QE in obviously 2009, 10, 11, 12. Then again, I think it was in 14. And then again in 2019, and then a lot more in 2020. And it was observable that asset prices moved every time it happened. And the correlation was very tight. And we were kind of trying to figure out, was this causation, correlation? None of us really knew, but we could observe it. 2020 comes along and it becomes strikingly obvious that there's a bigger force at play here. And I started to realize the force at play here was actually debasement of currency.
Hey, Money Talkers, welcome back to Money Talks, where we decode the wild world of finance. Smash that like button, hit subscribe, and get ready for the roller coaster because we're diving into the SEC showdown on the Bitcoin ETF drama. The SEC, the financial referees, are gearing up for a pivotal decision on a physically backed Bitcoin ETF. Nate Geresi, the Sherlock of the crypto world, warns us, if the SEC denies it in January, brace for one of the biggest crypto rug pulls in history. But hold the phone. He's almost certain it's a green light coming our way. The crypto community on the edge of their seats, biting nails as the SEC's decision, set to drop next month, could be a game changer. The recent crypto rally with Bitcoin soaring to $45,000, fueled by hopes of the SEC approving ETF applications from big shots like Cathie Wood's ARK investment and 21 shares. It's like waiting for the superhero to arrive. But hey, it's not all rainbows and unicorns. Bitcoin's chilling around $40,000, and if the SEC drops the rejection bomb, we might be in for a wild market ride. Wall Street giants are in the crypto arena, waving their banners. BlackRock, Invesco, Fidelity, they're all here for the crypto fiesta. Bloomberg Intelligence even predicts a $100 billion market if the SEC gives the nod. Are we on the brink of crypto history? We're at a crossroads, my friends. Bitcoin took a swing but missed the $43,500 jackpot. Instead, it's on a fresh decline, eyeing a dance with the $40,000 support. The crypto arena is buzzing with suspense. The charts are painting a picture. Bitcoin is below $42,000, and the 100-hourly simple moving average is playing hard to get. A bearish trend line is forming, throwing shade around $41,800. It's like a crypto tug of war, folks. But fear not, crypto warriors. Support zones are in sight. $40,600 and the trusty $40,000 are ready for action. If Bitcoin pulls off a superhero move and breaks $41,800, we're looking at a potential rise to $42,800 and beyond. Bullish dreams, anyone? Let's continue our discussion with Raoul.
I've spent 30 years in financial markets and in the macro world. I've been building macro frameworks my entire career. Most of my work had been based around the business cycle, which I still use today. It's incredibly important for pricing assets. But I started to see secular trends that were becoming interesting to me. Obviously, crypto I was very early in, back in 2012-13, where I identified this as a large secular trend. I've also ridden secular trends in India, the monsoon region around the Middle East, which I've got a big thesis about. Actually, it's around the Indian Ocean with India at the center. And that's been playing out as we go. My secular themes of debt, demographics, and deflation have been the ongoing theme of our time. But a lot of that was around, okay, we've got these structural massive imbalances to the system. And somehow it's going to resolve. And like most macro people, my framing of this was that it was going to end up in some sort of larger wipeout. But in my work around both the exponential age and at my work at Global Macro Investor, my research service, I started to realize that there was something else going on. And that once I'd seen it, I couldn't unsee it. Many of you will heard me talk about the Everything Code. Some of you may have seen some of the videos about it. but it's incredibly important as a framework for me. It helped me this year, get technology bang on and crypto bang on. Now, it's still a thesis. It's still there to be tested. But the thesis is that there is no way the global central banks and global governments can deal with this level of debt without monetizing it and debasing currency. Because the crisis is the worst outcome. The slow socialization or mutualization of losses across everybody's purchasing power seems more preferable because the voters don't realize what the governments are doing. And I think this is a globally acknowledged thing of what they're doing. So next week on The Journeyman, I'm going to update all of that. Where we are in the exponential age, the everything code, and the crypto supermassive black hole, where we are in the business cycle. It's my kind of lie in the land, State of the Union address, where we're going, what you can expect for next year. Now, I'm not always right, but I have a very clear framework of understanding so I can test it and test the robustness of it as we go. It played out almost perfectly this year. Again, doesn't mean it will next year, but I think it's going to give us a good guide.
If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.